All right, guys, this is Benjamin Smith with Caliber Home Loans. NMLS number is 372396. Just wanted to talk to you about interest rates a little bit. Because I got to tread real carefully on the words I use in this one, just for trigger terms and disclosures that puts out. But I'm going to use some very generic math. This math does not apply to anybody in particular listening. It is just a generic statement about some simple math about interest rates themselves and the impact on monthly payments. So in this example, I'm going to use the average transaction amount that I see locally, which is about $250,000, and we're going to talk just strictly about 30-year fixed rate loans. Okay, so on a 30-year fixed rate loan at 5%, the principal and interest payment is $1,342.05. Okay, that's just simple math. Doesn't apply to anybody. Your mileage is going to vary. Okay. With an interest rate just a little bit less, 1/8 less, 4.875, same terms, $250,000 loan, 30-year term, 4.875% rate. That math comes out to $1,323.02. Why are we talking about this? Because a lot of people really get very hung up on interest rates in believing that that is what's best. Lowest rate always wins, right? When you're looking at a comparison between lenders. And that isn't always the case, and I want you to see why. So the difference between 5% at $250K and 4.875 is $19.03. Okay, that's it. That's the massive. It's really not massive. That's the difference between payments. So we're talking about underneath $20. When you extrapolate that out by 12 months, that's $228 annually. We would all change insurance for $228 in savings annually. Is that better? Yes. Is the lower rate better? Yes, unless it costs you money. Okay, and here's the difference. We all hear about points. What are points? Origination points, discount points. Bottom line, those are fees that the lender is charging up front. Discount points are essentially to prepay some of the interest. So if that better rate on this $250,000 example of 4.875 costs you 1 point, which is the same as 1% of the purchase price, we're talking about $2,500 that you would pay upfront in the beginning of the loan in order to obtain that lower rate, if that's where things came out. Okay, so on that end, if you're taking $2,500 up front, but you're only getting $19 a month in savings, $19.03, then simple math, you take that $2,500, divide it out by the 19.03, you're gonna get 131.37 months. That's effectively 11 years you would have to stay in that loan until you've made up that $2,500 charge up front. Barely anybody stays in a loan that long, guys. Something else is going to come up. People are going to move. You're going to refinance. You're going to find a need to get into a different loan, interest rate change. Any of those reasons are probably going to come up in that time frame. Hardly anybody keeps a loan past 7 years anymore. So you would have to keep a loan a very long time. So when you're checking rates, you want to make sure that if there are discount points in that they make sense, that the payoff time is very short. And you need to consult with your loan person, really understand how long you need to be in the loan for that upfront money to really make sense. So that should give you a little bit of guidance in terms of understanding discount points and whether best interest rate always wins. Isn't always the case. You just want to make sure that your charges sort of add up and you completely understand what you're signing up for in these examples. Again, all of this is just basic math, mortgage math. This scenario has nothing to do with anybody. This is not built on any particular credit, just some simple mortgage math so you can understand the difference between what discount points cost and the payoff for that and really the difference between interest rates, 5% to 4.875. It's not a huge difference, guys. You really got to kind of really get deeper into your numbers and make sure you understand that if there's discount points, it's worth it. Thanks for listening.